Good afternoon. You're watching us here on Halftime Report. I'm Mangla Malu. With me, Ekta Batra as well as Sonia Shenoy. Not looking particularly good for our markets. The sell-off continues, not just from Friday, this morning as well. The intraday chart of the Nifty comes up for you at any given point in time. One had, bought the dip or, any sort of recovery as well. They would be sitting on losses. We're seeing a cut towards that 17,000 mark for the Nifty. For now, the 200-day moving average has supported, but who's to say how long it will continue to support given the weakness that we're seeing globally. Hi.
Hi, good afternoon, Mangalam. Afternoon, Ekta. I guess, when we talk about the Indian markets being resilient, it's just that we've not fallen as much as peers across the globe, right? I mean, if you look at it, the US markets, the S&P 500 is now down 20% this year, and our own markets have just about moved into the red. So yes, there is resilience, but there's a global tidal wave which is sort of taking all boats, and our markets are not too far behind. The mid-cap index is bearing the biggest brunt this afternoon. It's a 3% knockdown on the mid-cap index, and it just goes to show that the most vulnerable pockets are seeing some selling pressure right now.
Yes, absolutely, Sonia. And that stands true for a lot of these IT companies. So, for example, Wipro, which is now down over 40% on a year-to-date basis, TechM, HCL Tech, Infosys. And these were all of the stars in the previous year. So there's a lot coming undone in terms of the recession fears that we're facing globally. But just taking your point, there is some amount of resilience that you have to give the Indian markets credit for. And that is visible in the currency as well. So, yes, we have depreciated. Yes, we are sitting at a low for the rupee at this point in time, 81.5. We've crossed that mark. But nonetheless, it's important to point out that we've depreciated the least as compared to a lot of other currencies on a year-to-date basis. And this is at a point where we have been dealing with crude prices on elevated levels. So that has to be put into context. 9.5% depreciation for the rupee as compared to a lot of our peers which have seen greater depreciation. To take this conversation and a lot more forward, we have Ajay Srivastava, who's the CEO at Dimensions Corporate Financial Services, joining in now. Ajay, hi, welcome to the show. Well, it's a tough and rough market for us, but is it in any way an opportunity?
No, I think, let's not, the market has been good because it is responding correctly to the fundamentals. The way it went after the federal rate hike went up, I think that was the wrong time of the market of euphoria when they should have been looking at an interest rate hike in India. So if you ask me, technically speaking, the market has done the very correct thing, responding to what economic events are taking place. So it's a healthy activity that, your market is running in tandem with fundamentals. Now, having reached a point where now India is realizing that interest rate hikes are inevitable and large ones, knowing that RBI has fallen much behind the curve at this point of time, I think you need to curb your enthusiasm to buy stocks and look at more as fixed income at the end of the day. Bottom fishing is fine up to a point, but when you're looking at a scenario where your country's central bank has fallen behind the curve on interest rate hike, the US yields are at the highest level ever, in 2-year yields are at 4.4%. Inevitably, the best opportunity will come in the debt markets now, because there the interest rates should move up and move up quite substantially, giving you a healthy return compared to being in equity where growth will be sacrificed now very clearly, consumption will be further sacrificed. So, while you look at equities and says, can we get a return? I would say this is a time for fixed income investment, not a time to bottom fish for equities.
Actually, that was my next question, Ajay, because there's so much talk. Suddenly, these target maturity debt funds have come back into action, and there's a lot of interest now in the fixed income market. As you said, there's the Bharat Bond ETF as well. So within fixed income, what is your recommendation? How should investors go about it?
See, I think, the way we have planned our portfolio, I'm not here, everybody's got different situations, but where we planned our portfolio is almost 35% of our portfolio today stands invested in investment REITs, which is giving a very healthy rate of return on a quarterly basis. They still continue to give a good return of 9% plus. I think that would be one of the good places to be in. So would perhaps be, the REITs of real estate, but much less perhaps than the investment REITs of power companies. The second thing is you need to wait patiently. You don't need to commit capital to debt funds tomorrow. You need to wait patiently for this next hike of India to go through and maybe get a clear idea as to what happens and markets to come up a little bit more on the debt side. It's too premature to lock in your money on the debt fund today because you could make a loss thanks to mark-to-market eventually next 1 week. So I would say wait patiently, let the RBI policy go through, but investment trusts, REITs, etc., I think are a good place to be for the time being. And number two, I would say sincerely say that wait for a while to lock in fixed income. Don't be in a hurry because you might be victim of mark-to-market losses before the interest rates peak out.
Take that point, Ajay. So a lot of allocation to move from equity to debt is what you're recommending. But for the equity part of one's portfolio as well, do you think you would recommend a churn, maybe move out of sectors which had done well and now move into sectors which are not doing, which weren't doing well? There is some sort of, so to say, relative comfort out there. And I ask this specifically with regards to your views on the IT space, because IT has been resilient over the last few trading sessions. Weaker rupee helps them, and also the past underperformance too.
See, okay, so let me answer it differently. I think for Indian economy, the way you look at it, the segment which supply products and services to the upper echelon of India, consumer brand, I think they will be relatively less affected given what's happening compared to the economy segment. Very clearly, the consumption cuts will happen at the lowest end of the economy cycle of people, economic strata of people, compared to the top strata. So I don't think this whole upheaval will impact much of what we see, let's say, the five-star hotels. I don't think that we'll see that kind of impact coming there. Luxury product services, upper tier consumer durables, they will see less of an impact. What will happen is the people at the lower end of the consumer companies supplying to the lower end of the economic strata, those will get affected significantly more. The number two is, if you're saying where are the safe havens, I think the Indian consumer brands, which are in the category of 500 to 1,000 crores, and very good brands, they are there in the market, whether consumer durable, consumer products, etc. I think there will be a good place to be, not the 3,000, 5,000 crores, but the 500,000 crores, because given the consolidation happening in the economy, all these companies will be bought out in the next 1 to 3 years' time, and therefore you get a very healthy return. And these are good companies. You've seen some of the footwear companies, some of the retail companies have done reasonably well, and they continue to do well. Same is the QSR. QSR is a good place to hide. Their consumption may fall, but what will also happen is that the movement will take place from people spending bigger money on those kitchens, etc., the gourmet meals compared to the QSR meals. So I think QSR would be another segment where you would find relative safety in the market. The last point is, we're reaching a point where, if you ask me, contra investment, you're reaching a point where contra investment needs to be done with commodities at this point of time. Whether it is aluminium, whether it is zinc, whether it is, including steel, I think you're reaching a point where your return on capital employed will be significantly high if you invest at the bottom, almost bottom of the cycle as we are reaching, and we will reach in the next 30 to 60 days, compared to buying sectors of comfort like IT. IT, the problem is, let's say main company like Infosys, so much supply of stock can come to you and hit you that even if the fortunes of the company are good, the FPIs can just overwhelm you with supply of stock. So you can never make a return on it. So unless you want to keep a stock for 10 years, IT is not a good place for you to hide, because the sheer supply of stock is humongous which comes in. You got safety in your domestic stock at the end of the day. And nothing can beat the power industry, because with the new Electricity Act, I think it will see the best returns of any industry in the next 5 years. So I think, there are places to hide, places to work, and if you don't have it, you can average down. So it's not all bad gloom and doom. I think this gives you good opportunity. And remember the word FOMO. I think this tells you there is no FOMO.
Okay, all right, Ajay, we're going to leave it on that note. Thanks very much for joining in and speaking with us. So that's the view coming in on the equity market, that maybe it might be prudent to now look at the debt market at the fixed income space quite closely as well. We need to take a short break with the news that the markets are still reeling under pressure, recovered from the day's low. But on the other side, we'll get in touch with the company Meghmani Organics. The company will be joining in to share their business outlook, especially with the rupee at the lowest level ever. Welcome back. Well, it is definitely a weak market, and I just want to point out a couple of stocks which are at 52-week lows within the entire pharmaceutical space, and the sentiment of the market is actually very obvious in stocks such as Natco Pharma, because there is positive news in that particular counter today. They have managed to launch this particular agrochemical CTPR in the Indian market, and despite that positive news, that stock is still sitting at a fresh 52-week low today. Remember, the CTPR market in fact is a size of around 2,000 odd crores. So other stocks which are at fresh 52-week lows in Biocon, so that stock should come up up for you, down 2%. Pharma has been in a different orbit. There are concerns coming in from their Chinese-based promoter and maybe the liquidity of their holding company. So that stock is down around 4%. Met Plus too is a relatively new listing, so that stock too is seeing some amount of pressure today. But let's talk about the chemical space. We have Mr. Chal, who is the CFO at Meghmani Organics, who joins in to decode the impact of the energy crisis in Europe on the Indian chemical industry, as well as the impact of a depreciating rupee. Hi, sir. Welcome to the show. If you could start by giving us a sense in terms of how the export business is doing, considering that, the energy crisis is weighing on Europe. We are talking about a global recession even more. Tell us how business is for you. Has there been any sort of direct impact on demand?
Good morning, and thanks for the invite. As all of us know, so globally there is a fear of a recession which is going on, and top of it there is a energy crisis in Europe, and there is a drought situation in China, Europe, and even in our US. So overall demand is low. That is definitely impacting all the industries. And another factor is the year end, which is the calendar year globally, which is followed. So in the third quarter, normally it remains slightly low as compared to other quarters. So this is the overall demand scenario. But on the positive side, if we see, there is no pipeline inventory as of now. So channel inventory is almost negligible, which is specific to consumption only. And once the demand approves, I think uptake will start in the coming quarters.
So when you say that the demand is low currently, Mr. Chahal, can you give us some numbers on what this could mean in terms of your growth, on your revenues as well? Because on a quarter-on-quarter basis too, your revenues were actually down 4%. Do you see further pressure?
Definitely there are two ways. One is demand, second is on the price front also, because when the recession fear is there, so no buying happen, demand is, and prices are also contracting across the globe. So that is another factor. So definitely there is a pressure on the top line also. In line with that, there is a reduction in raw material also. So we more focus on the EBITDA margins than the top line. So definitely top line is important, but EBITDA margin is something which we keep track of that. So where are we focusing on?
So what can you speak about in terms of EBITDA margins? What are you focusing on? Because Q1 you did about 17.1%. Can you give us a sense of, input prices, whether they're going up or not? Prices for 2.4D, which is roughly about 20 to 25% of your revenues?
Yes, 15 to 20% is coming from 240. And another major product is the pyrethrin, which is China competition. So these are two major products which constitutes almost 30 to 40% of the top line. So price has gone down for both these products and simultaneously raw material also. So that will have an impact on the top line. Definitely, but in our case, if you see where the demand currently comes from, so if we see where the major recession in Europe, so Europe in agrochemical, we have a less than 5% exposure. So that will not have much impact. In case of pigment, we have a 10 to 12% exposure. So there we see a lot of pressure coming in case of pigments.
You mentioned China fleetingly, so I wanted to understand that do you benefit at all from the China Plus One opportunity? Have you already benefited in terms of business?
Definitely, because the China Plus, it is the overall, which is the sentiments prevailing, but it will not happen on one day. The global customer look on the long-term perspective, and they look from the suppliers who can supply on a sustainable basis. And definitely we are interacting, and we are currently also, we are supplying to all multinationals. The multi-purpose plant which we are coming up with, and now we are able to demonstrate our infrastructure also, where we can supply, and the products which we are coming up is with backward integration. So definitely it will have impact, and we will see a lot of traction from multinationals. We will be supplying to them.
Okay. So if you are seeing increasing pressure in the pigment space, you're saying that demand from Europe is quite muted at the moment. Would all of this put pressure on your balance sheet? Because, you know, your gross debt currently is in excess of 400 crores. Do you see your working capital rise, your debt figures, do you see them rise by the end of the year?
In the short term, there are hiccups actually, as we see a lot of disruption is happening. But on the annualized basis, we see we will be remaining in the range actually. So in case of agro, definitely between 16 to 19%, we will be able to achieve our EBITDA margin. Same way in case of pigment also, it is 9 to 10%. So we will be remaining there only. So overall, if you see, debt is only less than 400 crore long-term debt, where my debt equity currently stands at 0.34. And as a guidance also, what we are keeping is we will be maintaining below 0.5. So we don't see much leverage on our balance sheet. So we have a very strong balance sheet.
You have a lot of capex as well, along with a strong balance sheet, because you were on track to, commission your phase 1 of the TO2 plant, the titanium dioxide plant, as well as the MPP plant. So just wanted a quick refresher on that, whether these plants are on stream. And secondly, on MPP itself, you said, what, 350 crore capex. What's the revenue opportunity here?
Yes, so both these projects, in case of agro multi-purpose plant, that is on plan. I think the mid Q3, we are going to commission that project. And in case of pigment also, by end of Q3, so we'll be commissioning the first phase.
Okay.
From the revenue perspective, because this is the new chemistry as far as titanium dioxide is concerned, so we are not anticipating much revenue. Our more focus will be on the stabilization and acceptability of the product. And from next year, definitely there is going to be at least 50 to 60% capacity we will be running in this plant. And we expect that between 200 to 300 crore top line should come from titanium dioxide in pigment division. And in agro division, in the growth, when we are commissioning in the mid of next quarter, and a ramp up will happen, and we see around 50 to 60% capacity utilization in the next year, 23-24, and then it should add 350 to 400 crore of top line in agro division.
All right, Mr. Chal, we'll leave it at that. Thanks a lot for joining in, and all the best for the quarter to come. Well, that's the word coming in from Meghmani Organics. They do say that there is pressure definitely in a market like Europe. And although they are confident of, maintaining their margins, overall demand is quite low, and that's the reason why the stock is down about 3% as well. But let's do one thing before we slip into a break. Here's some great news for investors. You can now track the US market action real time on Money Control. Log on to Money Control website or the app and stay informed about all that matters in the global markets. Welcome back to Halftime Report on CNBC-TV18. For now, the market is still under quite a bit of pressure. The good part is that the selling pressure hasn't accelerated. It's still down, but not worse than what it was, say, 2 hours ago. It's still down about 280 odd points. So let's see. Let's talk about individual stocks now. There is M&M Finance that continues to be on our radar. Morgan Stanley has an overweight rating on the stock, while Jefferies maintains its underperform rating. So it's a bull versus bear situation happening here. Abhishek is here to give us more on that. Abhishek.
To begin with, stock is down about 20% in last 2 trading sessions, and total trade volume was around 852 crores, which is the highest in last 3 months that we are seeing, or 4 times the last highest that you saw on Friday. So there is a bull versus bear scenario, wherein the bull is Morgan Stanley, who has an overweight rating on the stock with a target price of 225 per share. They have cut down on EPS forecast mainly on account of lower net interest margin and higher credit costs that they see. So RBI's ban is likely to cause FY23 provisions with reversal in the future, as and when the net impact can then be on the lower side. There is fear of moral hazard and macro volatility, which could weigh on the stock performance in the near future. We have a bear case scenario coming in from Jefferies, who have an underperformance rating with a target price of 155 per share. They say that RBI RBI's ban could lead to 75 to 80% drop in repossession activity. Hence, this could lead to higher loan losses or loss given default or NPAs till it gets readjusted with the processes that are following up. So a 5% higher loan loss on assets could actually increase the credit cost anywhere between 10 to 15 basis points. Back to you.
Okay, all right, Abhishek, thanks very much for that. So yes, the jitters began last week for M&M Financial from the NBFC space. But Maderson is the other one which is in focus. That is because of a large acquisition in Japan, Sonia.
So it's actually from Maderson's perspective, it's a fairly small acquisition if you look at it from a value perspective, right? But why it's important is because it's the first acquisition that Maderson has made in Japan. So the company will acquire the mirror business of Ichigo Industries in Japan, and this is for a sum of 5.2 billion yen. Now the intention is to buy the automotive mirror business of Japan and get into that market, you know, Japan, China, Thailand, Malaysia. Now, Ichigo Industries is one of the leading manufacturers of automotive mirrors in Japan. It caters to a lot of the OEMs over there. It has 3 manufacturing plants across Japan and China. And if you look at the sales figures, right, it is an EBITDA positive acquisition. The sales have although been under a bit of pressure. So in FY19, the sales were 22 billion yen. It's gone down to 15.8 billion yen by FY21. Although it is EBITDA positive, in FY21, 1.3 billion yen was the EBITDA of Ichigo Industries. Now, Japan is actually the 3rd largest automotive manufacturing hub in the world. And hence, Samvardhan Maderson is getting an entry into that space, which is a positive. This is also the 3rd acquisition from the Maderson stable. This is during the current 5-year plan, following its acquisitions in both Turkey and China. So in that sense, it's positive. But yes, it's a fairly small acquisition.
Small acquisition, but strategically important for Maderson. Samvardhana Maderson, that is. The stock, of course, on account of the weakness that we're seeing in the markets, down about 4% despite the acquisition announcement. But one of the stocks which is underperforming for the last few trading sessions is Power Grid. It's among the top F&O losers for the 2nd session running. Remember, on Friday itself, it was down by almost 8%, currently sitting at the cut of closer to 6%. Vivek joins in to tell us what's the reason behind the fall and what's spooking the street. Vivek.
Well, that's right. For the 2nd straight session, it's one among the top laggards as far as the entire market is concerned. So now, the other thing to keep an eye out for is even the volumes as well as the delivery on Friday was quite high. So the main reason for this particular development and the sell-off that we are seeing in Power Grid is the fact that there are a few news reports that actually say that the Power Ministry is in talks with Power Grid for Power Grid to go ahead and purchase Power Finance Corporation's 52.6% stake as far as REC is concerned. Now, this particular development, it's by other media sources and other media agencies. So far, the Power Minister, Power Grid, REC and PFC, neither of them have confirmed or even commented on this particular development. But on the back of this particular development, there have been brokerages that have gone ahead and done a scenario analysis on how exactly this could impact Power Grid. The first thing that they say is that, so far, Power Grid has not been forced by the ministry, or Power Grid has not been asked by the ministry to go ahead and make any other investments in other companies. Also, what they're saying is that, when you're talking about other PSUs, they have made investments outside the ministry directives, but Power Grid has remained relatively insulated. A dividend yield, according to, Jefferies, they believe dividends could be much lower at 4% versus 6%, and they believe that this particular development could act as a significant sentiment dampener as far as the near term is concerned, and could lead to a significant valuation derating, which is what we are seeing as far as the markets are concerned.
Okay, all right, Vivek, thanks very much for that. That's on Power Grid. That stock has lost around 17% or thereabout on a month-to-date basis. Time for a break now, but up next, we'll be talking technicals on the other side. Stay tuned.
Well, the market's down, but not out, because we're seeing a wee bit of recovery from the lows on the Nifty, almost 100 points from today's low. But importantly, there are 3 sectors which are relatively resilient as we speak. IT, we've been talking about the impact of the weaker rupee. Pharmaceutical stocks also outperforming. We have Divis, which has moved to the high point of trade in an otherwise weak market. And then lower commodity prices and higher domestic economy focus keeps the FMCG stocks interested in today's trading session as well. So at the high point of trade is Asian Paints. Alongside that, we have Nestle too, which is sitting with a gain of about 1%. So these are a bunch of stocks which are outperforming. But the big outperformer from the broader markets is actually the debutant on the street. We have Harsha Engineering, opened about 40% higher versus its issue price. So in our special segment, Insight Edge, we have Vahista giving us an edge over what the insight that the management provided us in the interaction we had with them.
Hi Mangalam, well thanks for that. Harsha Engineers International has made a very strong debut today in a weak market, and it lists at approximately 450 rupees per share versus the issue price of 330 rupees, and this is because the market is pretty optimistic on the fact that the company will be able to capture the growth recovery in the auto ancillary space. The IPO was subscribed 75 times and is one of the highest subscribed IPOs in the QIB category in the history of Indian equities capital market. So the issue size is 755 crores, which includes a fresh issue of 455 crores, and the remaining 300 crores comes from the offer for sale. The company primarily operates in two segments. One is the engineering and the solar EPC business. The engineering accounts for the major chunk of approximately 95% of revenues. The company also has a 50 to 60% market share in the Indian bearings cages market in the organized segment, and the money that will be raised from the IPO is expected to be utilized for the repayment of debts and funding their capex and for repair of the plant and machinery. Now, at the listed price, the stock is available at a price to earning multiple of approximately 45 times its FY22 earnings. We had the management on our channel earlier today morning, and they had said that the company is pretty confident on growing faster than the industry growth rate, which is in the range of 6 to 8%. The company is not expecting any large debt raising in the next 2 to 3 years, and they are targeting 110 days of working capital days. Back to you.
Okay, all right, Vahishta. In fact, we did speak to the management earlier in the morning, so let's listen in to what they had to say.
As I mentioned, there are a lot of factors going into that. Industry, what we estimate is going to grow 6 to 8% is the industry growth. And again, as I mentioned, that because of China Plus One and outsourcing, quite confident that we can hit the teen numbers. Again, difficult to put in an exact number on that. We don't expect to do debt raising anytime soon. We have investment plans to support our customers' growth and in line with that. So next 2 years, we don't expect to raise significant debt. We will probably work with some working capital if there are relatively cheaper side because we do a lot of exports and we get a lot of those opportunities. But beyond that, we don't expect to raise significant debt. We target about 110 days of complete end-to-end cycle for us.
Okay, well, a great listing there in what is a weak market. We need to take a short break, but on the other side, more on the technicals, more on the market. Stay tuned. Welcome back. Well, let's get talking about the technicals of the market. Jay Thakkar joins in now to tell us what his strategy is at the start of the week on a weekday such as today. Jay, hi, welcome to the show. So what are your stocks as well as your technical calls on the Nifty as well as maybe the mid-caps?
Hi, good afternoon to you. And as far as the index is concerned, I would say that Nifty has bounced back quite well from its lows, almost 150 points now. And I think this bounce back can continue till the levels of 17,200, 250 on the upside. The index have bounced back from its almost 200 DEMA as well as from quite an oversold territory. I would say the PCR has fallen to almost 0.5, and we have seen the net long has also come down below 20, and that's the level wherein from where you get the decent bounce back. So the overall trend can be negative going forward, but the short-term bounce cannot be ruled out till the levels of 17,250 on Nifty. And as far as Bank Nifty is concerned, we can see that bounce come till the levels of 39,200. The first buy recommendation from my side would be on Sun Pharma, from the defense space. Sun Pharma has seen a good long build-up since past couple of trading sessions now. The momentum indicators, technically both on the daily as well as weekly charts, have come well into the buy mode. The stock has provided a breakout from a falling channel, and the stock is likely to move towards the levels of 940.45. These will be its this will be its immediate target on the upside. On the downside, I believe that 905 is a very crucial support for the stock, and that can be a stop loss My first buy recommendation here would be on a Sun Pharma, and second buy recommendation is on Marico. Now we have seen that consumption stocks have also done quite well, and Marico has fallen today by almost 1.5%. But then this dip should be utilized as a buying opportunity. I believe that the way the momentum indicators have also reversed here from sell to buy, and we have recently seen a breakout on this stock from the range of 545.30 to 500 points. So there's a 40 points breakout on the upside, which can help this stock to move towards the levels of 570, 580 zone. On the downside, one can place a stop loss at 520. So there is a decent risk to reward on the long side here as well. So Marico and Sun Pharma can be both at the current market levels. And I think that Nifty can also bounce back, Nifty and Bank Nifty both.
All right, got that. Thanks a lot for that. Just want to mention that a lot of IT stocks are now hitting fresh 52-week lows, so don't lose sight of that. As we speak, Wipro, Infosys and TCS are all at fresh 52-week lows. In fact, Wipro has now lost 45% of its value this year. Of course, the stock is bouncing back a bit, but it's hit a fresh low and then bounced back. Infosys as well is now down almost 30% for the year, so not looking good for the IT stocks at all. Underperforming the market in a big way. Perhaps the green on the screen today is just, disguising the fall a bit, but it's been a really, really rough ride for the IT names.
That's correct, and you spoke about bouncing back from the lows. Actually, the market itself has bounced back quite a bit from the lows. In fact, from the 200-day moving average, the Nifty is up almost 140 odd points. The Nifty Bank as well has pulled back a good, 100 odd points, 200 points from the 50-day moving average. So there has been a bit of a bounce back. We've seen a wee bit of recovery on Dow futures from the lows as well. But the question is whether it sustains or not, and what happens in the second half. What we'll do is take a short break from not just the show, but also the equity markets. Come back on the other side. We have Manisha Gupta with Jonathan Barrett talking about all things commodities.
Welcome back. Joining us on the show now is Jonathan Barrett of Probus Securities. Jonathan, hi. A difficult start of the week, and almost everything from where we left it on Friday seems to be picking it up and selling it even more. I want to start with the crude oil prices. We're trading at an 8-month lows now. We're below 90. We're below 80 for WTI. It is oversold on charts, but where do you see it going?
Oh, I like that comment. It's oversold on charts, but you're a very brave person to try and buy it at this level. Obviously, US dollars are quite strong, but at the end of it, I think we are really running at thin capacity. I'm hoping that the capacity in the market should start to pick up, but I think the ability for the market to produce when it needs to is not there. But at the moment, the trend is certainly lower. The sentiment is certainly weaker. So I think prices can continue to trade lower from here.
I was reading a report which suggested that, and this is an IEA report, I believe, it says that we are almost into a surplus now for this quarter. I mean, what does it really mean for the prices, and how concerning should we be for the demand views going forward?
Well, I think generally when you look at where the price is now, when you think that there is a surplus on that, then the market's sort of starting to think that obviously we are sort of going to slip into that recession. Those recessions sort of obviously we see demand come off. As a result of that, I think you can see Brent crude oil probably trade down to that US $80 a barrel. But at the end of the day, I guess let's look at what happened when we had the last hurricane that came through, or looked at it. It really didn't do much to the price. So I think the theme is still recession. And as a result of that, I think prices still remain quite weak. Supply side, when will demand side?
All right, that's a bad line, but you were making a very important point on where do we see the demand and the supply going forward. Well, yes, the crude oil prices have continued to decline. The high of this year clearly has been at 139. From those kind of levels at 85 for Brent prices, and WTI has continued to decline. It's broken below 80 as well on the screens there. More than a percentage point of a decline coming in for crude, but crude is just one of the commodities which has seen a decline. We are looking at that kind of a sell-off across other commodities also. Take a look at the base metal prices. We've come off highs by nearly 25 to 35% for many of the metal prices. If you look at copper and zinc, we are trading at 2-month lows. Aluminum is trading at a 17-month lows. Jonathan, I was making a point about a sell-off that has continued in metal space as well.
Yeah, absolutely. A lot of weakness there. And when you look at it, it's obviously a lot of strong dollar, but also demand, particularly when you look at copper. Quite interesting that it is under a lot of pressure, even though we have inventories quite low in a lot of the warehouses. So that to me is a worrying sign. I think the metal markets can flip around quite quickly to be bullish again. So I don't mind actually looking at the weakness, particularly in copper, particularly in aluminium as well. But copper, I think if we do get a good dip and a good bounce, that's something to look for. Remember, warehouses, supplies are low, and if there is a little bit of a flip round, then this market could have some legs on it.
All right, so metals could be a buy pretty soon. How are you also looking at the gold and silver prices? Because very sharp decline there. And what's your sense now on the dollar index? We've done 114, I mean from 110, 111 to 114 has been really quick. But from here, what's your sense?
I think when I look at gold and silver, look, still under a lot of pressure, but it has had a large move to the downside. It is all US dollar related. There's no doubt about it. So naturally, as you've sort of looked at the US dollar, where does that dollar index go from here? And I think that to me is the concern. How far can it go? The interesting thing there is on the balance of payments in the States. Doesn't seem to be too much of a dent. So I think the US are quite happy to see that US dollar remain relatively well bid. And as a result of that, our precious metals are going to come under pressure. But I think at the end of the day, once we get a turnaround in that US dollar or a little bit of rhetoric, which I do expect to come from the Fed at some stage, that the US dollar is too strong, then we'll get a turnaround. But at the moment, whilst the dollar is where it is, I think you'll find precious metals will remain under pressure.
Under pressure. Jonathan, Manisha, thanks a lot for joining in. In fact, let's keep it with the metal space now. The steel sector is also in focus. Jefferies has come out with a note on the Indian steel sector. It sees a further downside risk to steel prices, which have in any case been under pressure. Nigel tells us all about that. Nigel.
Well, that's right. Jefferies is sounding fairly cautious on the metal space. So let's start off with Ferris first. They believe that it's too early to get constructive on the steel space. And they've given us a few reasons. First, on pricing, they say that, yes, steel prices are down by around 19% from the averages that we saw in June. But they believe there's further downside risk to these prices. And the key reason they're saying is import parity prices, well, they in fact are still 6 to around 11%. That's domestic prices are still 6 to around 11% in comparison to imported steel. So that's one factor at play. They go on to say that now India is an oversupplied market. And a few reasons that they've given is in the past year, that's in FY22, they exported close to 13 million tons of steel. But there was an imposition of close to 15% on export duty. And now the annualized rate is close to around 5 million tons, which has led steel inventories to spike up. And that's the highest levels we've seen in the last 18 months or so. They say, yes, India demand will improve, but globally, well, things are in a bit of a flux. And that's what could hurt global demand as well. They're given a few numbers then on a couple of stocks. On Tata Steel, EBITDA per ton, they're expecting it to fall from around 29,000 odd all the way to around 14 to around 16,000, though they say that this is pretty much in line with what they did between 2005 to 2022. For JSW Steel as well, they are saying that the EBITDA per ton could fall to around 8 to around 9,000 odd from around 19,000. But they're saying that as well is in line with what we saw in the previous 15 years. On the valuation parameters, they prefer Tata Steel in comparison to JSW Steel, though they are fairly cautious on the space. Moving to Hindalco, they have a hold rating with a target price of around 390 rupees. The stock is trading at around 1 to around 0.9 times price to book value, though they say in the past, it's traded at even half times price to book. And on a 10-year average, it's around 0.8 times. A few factors at play. Ball Corporation, that's one of the biggest clients for Novelis. They have pulled back their guidance, which will hurt them. And on the domestic front, you have aluminium prices, which has drifted lower, and that's what could cause the EBITDA per ton to fall all the way from around $1,300 per ton to around $750 per ton. Put all this together, well, Jefferies is fairly cautious on the space. Back to you guys.
Right, Nigel, thanks a lot for that. So that's about the metals pack right now. With that, we wrap up on this edition of Halftime Report with the news that there is a mild recovery that continues. Let's see what happens. Business Lunch will take all the action ahead.